a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about Target Date ETFs. And we are talking about Target Date ETFs because BlackRock launched the first suite of Target Date ETFs last week. Now, Target Date funds are quite popular. They are popular in 401ks, company-sponsored retirement plans, but they are mostly in mutual fund or CIT, collective investment trust form. This is the first suite of Target Date ETFs launched after a long time. So let's take a look at them, whether they are suitable for you and what they do. So talking about the Target Date funds as such, these are designed for set it and forget it investors. So if you are retiring in, say, 2025 or 2065, you can have exposure to a mix of stocks and bonds according to your retirement date. So they're designed specifically for those specific retirement dates. And so as your retirement date approaches, your asset allocation will move from riskier stocks to more conservative bonds over time, and that is called its glide path. Now, talking about the iShares Target Date ETFs. So last week, as I mentioned, they launched 10 iShares Life Path Target Date ETFs. These target retirement dates from 2025 through 2065. So BlackRock earlier offered a suite of Target Date ETFs, but they liquidated those Target Date ETFs, which they were not very popular. So they liquidated in 2014, but the ETF industry has changed a lot since then. Over the last 9 years, assets have gone up significantly. Now we have more than $7 trillion in assets, and ETFs are quite popular with younger investors. So it remains to be seen whether this time iShares will be successful with these ETFs, but it makes a lot of sense. And all these ETFs, they are actively managed, though there would be not a lot of change in asset allocation. And they follow ETFs approach. So they will hold a mix of iShares ETFs, which are suitable for that particular retirement year. Now, BlackRock is targeting taxable account through these ETFs. And according to BlackRock, there are 57 million Americans who do not have access to employee-sponsored retirement plans or 401ks, because those are taxed as advantaged accounts. 401ks and other retirement plans are tax advantaged, whereas taxable accounts will benefit more from the ETF structure, because we have talked many times about the tax efficiency of ETFs. So having ETF structures makes more sensible if you are holding target date ETFs in taxable accounts, or if you're saving for your retirement account, if you do not have access to company-sponsored 401k and you are saving through your taxable accounts, then these make a lot of sense. Now let's take a look at some of these ETFs by going to the quote page on Zacks.com. So if you look, we'll take a look at two ETFs, the one with target date of 2025. So if you're planning to retire in the next 2 years, and we'll take a look at this one, ITDI, if you're planning to retire in 2065. So before that, I wanted to show you some research material that iShares has. So if you want to learn more, you can just use the link on the Zacks.com quote page, and you can go to iShares webpage for these ETFs and look at the research that they have put on these kind of funds. So this is what they do. So they move from stocks to bonds as you approach your retirement date. So at the start of your career, you should take on a lot of risk if your retirement date is decades away, and you should invest in riskier, growthier stocks because stocks will fetch higher returns over the longer term. So at the start of your career, you should have about 99% allocation stocks, according to BlackRock, and as at retirement, you should have about 40% allocation to stocks. So let's take a look at these two ETFs that I mentioned earlier. And incidentally, BlackRock has some more research. So if you're interested in these funds, take a look at these research materials. You can watch those videos. Now, going back to these two ETFs. So if you're a young investor and you're planning to retire in 2065, your retirement date is decades away, then your target date fund will look like this. The expense ratio is 11 basis points. And if you look at the exposure, these are the holdings currently. And looking at the exposure breakdown, because you are taking on a lot of risk, so you have a lot of international exposure as well. US assets account for about 60%, and 40% is international, including emerging markets. Looking at the asset class, as I mentioned earlier, because you are a young investor and you are taking on a lot of risk, so your equity allocation is close to 99%. Just 1% is in fixed income. Now let's take a look at the other ETF that I mentioned. So this is for people who are planning to retire soon in next 1 or 2 years. So this is what your exposure will look like. You will have about 81% exposure to US, and rest is international. And in terms of asset class, you have about 42% equities and about 58% fixed income, a very conservative risk-averse allocation. Now, should you buy these ETFs? So it really depends. So these are more suitable for like one-size-fits-all approach. So as I mentioned earlier, these are set it and forget it investors. And if you are worried about volatility in the markets, and in the past, if you have tried to time the markets and you have exited the market at a wrong time, because we know market timing doesn't work, you have to be patient with markets. So if you're worried about volatile markets, and we have seen that markets have been quite volatile and they may stay to be volatile in the coming months, then this approach makes sense for you. And also these are very cheap ETFs, so you get fund of funds within an expense ratio charging just between 8 basis points to 11 basis points. So low cost solutions for your retirement. And it makes sense if you are worried about volatility and if you have tried to time the markets in the past. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our video channels, so that you do not miss anything. And I'll see you next week.